What's the next section? Let's talk about contribution incentives for retirements. All right, I don't like the word incentive. Because incentive in terms of what we've got in place here doesn't refer to the same incentive as what we believe it to be. If you look at the Act currently, the new version, this is already in the Act. It is only applicable from the 1st of March 2015. But if we look at our notes that we have, basically where we sit in the situation is, and this is on page 5 of the notes, and we look at the background. Obviously there's an intention by government to promote savings for retirement purposes, right, which they want to factor into effect for the pension providents and retirement annuities, things that we already have in place. However, there's a big problem. Why? Because of the nature of the contributions that we are making. But like for a provident fund, they're normally only company orientated. Why? Because the company at the end of the day gets the deduction, but the individual is not taxed. We all know that process, all right? So you normally have company contributions to a provident fund, and for a pension fund, because you're entitled as an individual to 7.5% deduction at the end of the day, you will then effectively have a 7.5% company contribution and a 7.5% contribution from the individual. Why? Because you get the tax deduction. We're all aware of that. That's how it's operating. And then also we have our retirement annuities, which allows the 15% at the end of the day on whatever your taxable income is. So what has been happening? And specifically, this is not new. It has been in the market space for a while. So now I reach the age of retirement. I get my provident fund paid out to me in total. That happens today, Tuesday. By Thursday, I'm standing at the social grant offices, applying for an old age pension, applying for social grant, because what did I do? I blew all my money. That is the reason why they're looking at changing this whole process into everything being aligned on a 1/3, 2/3 scenario from a pension, provident and retirement annuity, to stop people blowing their money in total. What is the other thing that's happening lately? We're having supper last night. I've got a provident fund. I look at the cash flow. Oh dear. We can't do the trip, we can't fix the house, we can't pay the school fees, we're in a problem. So I tell you what, love, let's get divorced. And I'll give you 100% of my provident fund. So you go to court, piece of paper, divorced, 100% of the provident fund, paid out to the ex-spouse. That next evening, you're celebrating. Now these are all to prevent these type of things happening, to ensure that people are looking at their retirement aspect. Just as a matter of interest, how many people can actually retire today? None. Look at all the old people, and I'm referring to like my in-laws in the 80s and that, they're 80 years old. They can't survive on their pension, because what happened in terms of our inflationary rates and the costs and everything else. When they told you in 1960 you're going to get $1 million, you thought you're going to retire and live in Camps Bay or something. Where now you get $1 million, you're lucky to find an apartment, never mind a house in any area at the end of the day. So from that perspective, there is changes, but it's not going to be that great in that. What are these new things? I just want to point out your employer contributions and look at something that you need to be aware of. If you look at 1, employer contributions, which is on page 5. As a matter of legislation, taxable employers may deduct contributions to a pension, provident or benefit fund in an amount at least equal to 10% of the approved remuneration of covered employees. So in other words, in the Act, we have under approved remuneration, we have a situation where they're saying if you as a company are making any contributions to a pension, provident fund and a medical aid, because a medical aid is also seen as a benefit fund, it may not exceed 10% of the individual's remuneration. That's what the Act says. However, in law, in terms of, I shouldn't say in law, but in terms of a legitimate expectation created, SARS will allow up to 20% in practice. All right. Now with the amendments that have been made to Section 11K and 11L, they are now removing pension, provident, company contributions from the definition of approved remuneration. So all that's going to be left in terms of approved remuneration at the end of the day is your contributions to the medical aid. Now we've got to be careful on that, because irrespective of how the medical aids are treated from a tax perspective, you know, you're talking about your medical tax credits and all the rest of it. If it is a company contribution and that company contribution exceeds 10% of your remuneration, the company will forfeit that deduction for income tax purposes. Okay? It's excessive. That's what it's deemed, excessive remuneration. Please have a look at that, because a lot of people these days, when the medical aids open their doors and said, fine, it used to be a direct family and a direct dependent that you could contribute for. Now you can contribute for anybody. You can effectively load your granny, your auntie, and whatever else onto the medical aid. And if the company is paying that, it cannot exceed 10%. So please do your check on your payroll parameters. This is obviously going to be effective from the 1st of March 2015. So make sure your payroll parameters are correct, that you're not exceeding those 10% contributions.
Can you just explain to me again what it does if it exceeds 10%?
Okay. No.
What happens?
The question is, if the company contribution exceeds 10%, what happens? Effectively, there is no taxability of the individual. So in other words, the employee from PAYE perspective, there's no change. But SARS will disallow whatever amount exceeds 10% of that remuneration for income tax purposes. So in other words, you will lose the deduction of the amount that exceeds 10% of that individual's remuneration factor. So in other words, let's say you're contributing, if you work it out, and here's the medical aid and here's my salary, and it's 15%. That 5% will be disallowed for income tax purposes as a deduction. Yes, sir.
By removing the company contribution benefit, is there any reason why not to just make everything a deduction? I mean, could SARS challenge it? Because there's no tax benefit to structuring medical aid, pension, provident, whatever. Whereas, I understand SARS doesn't like you doing something for tax purposes, but I mean, we're just simplifying a guy's payslip to say, based on grounds of simplifying the remuneration, we're going to make everything a deduction.
Okay. The question for those on webinar, and just correct me if I'm wrong, Dave. Effectively, would there be any problem if we, instead of having company contributions at the end of the day, purely show everything from a simplistic format, because there's obviously no tax difference in that, purely show everything just as a deduction in terms of that. So in other words, give remuneration, no company contributions, just to simplify the process. So in other words, you don't run the risk of having exceeding the 10% on medical benefits and all the rest. The problem there is that it is not what we're doing going forward. It's what we've done in the past. Okay? Now, that's where your risk ratio lies from a SARS perspective. And if I put it into perspective for you, how many changes have happened to the medical aid over the last 6 years? Every year something changes at the end of the day. But let's go back, and I'm going to use this as an example. So in other words, you can do what you're saying, but you need to apply your mind to what's happened in the past. You remember the good old days when the company contribution only used to be taxed on a third for medical aid? And if there was a 50-50, there wasn't. So what would happen is the companies would then structure and say, fine, your contributions to the medical aid are going to be seen as a company contribution. Right? Now, in the same light, you have now confirmed that it's a company contribution, and it stays like that. When the Act amended to say it doesn't matter who pays the contributions anymore, there's going to be tax credits in place. If you go and change that relationship now that is not a company contribution anymore, now it's just part of your package at the end of the day, you run the risk of effectively SARS going back and saying, what was your true intention when you were showing it as a company contribution? Are you following what I'm getting at? So your risk is not current, your risk is what was your intention at that stage. And that's where the problems come in with salary sacrifices and things like that. So if I initially salary sacrifice and I did it correctly, a provident fund contribution. So how would that operate? I was on a pension fund before, I paid 7.5, company paid 7.5. So we then moved to a provident fund, and what did we do? We said, okay, fine, I will give up my 7.5% on the quid pro quo that the company will then give me the 7.5% as a 15% contribution to the Provident Fund. You're following what I'm getting at? So that is now the intention, natural structure. So it's a company contribution. If you were to now go along and say, fine, from the 1st of March 2015, we're not going to have it as a company contribution anymore. We're purely just going to put it as part and parcel of your package, because effectively it is part and parcel of your package. SARS could challenge you saying that, well, why have you changed it? And your only answer response is, I want to simplify because there's no tax benefit. And as soon as you mention the word tax benefit, then we need to determine whether or not it's tax evasion or tax avoidance. And that creates your audit problems. All right? So you've got to be careful when you make these amendments. I have logical reasoning, but I agree with what you're saying. If it is simplification and you inform the staff, so in other words, there better be a roadshow and everybody understanding that effectively this is the way going forward, what's the negatives, what's the positives. Also bear in mind one thing. It doesn't make sense to me if I've got a company contribution for my medical aid to effectively have that in my own package. Why? Because when a medical aid goes up in January, you know they go up in January, they can't go any other time. Normally that would mean there would be an increase in my total package because the medical aid is increased at the end of the day. Whereas if the medical aid increases and it's my own contribution, what's going to happen? My net salary is going to go down. You're following what I'm getting at here? So that's indication that if that is now the process you're running, that in the past you were running an illegal salary sacrifice. So you've got to look at the 5-year period. We're in 2015 and going back to 2010 when that medical aid stuff was still in place. Did I answer you or did I confuse you more?
No, it's fine. I'm just thinking where you've got a cost to company, you've got 100,000 rand. That 100,000 rand doesn't change when the medical aid goes up.
Okay, so it's not. So in other words, because there's no change on your cost to company when your medical aid goes up, that effectively means it's not a company contribution; it's effectively your own contribution. So that's what the substance is. What I'm referring to is where you had a bona fide increase aspect, and now all of a sudden you're putting it in a package. Right. So anything you want to do, look at going forward, but look at the historical aspect to make sure that you are not exposing yourself unintentionally to something that could be construed as an invalid salary sacrifice. Because obviously if they go back 5 years, you're going to land up with a bit of a problem. Now what has actually changed? They're saying that both employer and member contributions, retirement annuities and all the rest. We need to look at page 6, which effectively is the member contributions. And everything I've got in this little book, I've pulled off SARS's website, okay? I'm sure you recognize the memorandum of proposals that we're going to be changing at the end of the day before the December Tax Revenue Amendment Bill was passed. Now what they're basically saying is how are we going to contribute going forward from the 1st of March 2015? Basically, each individual will be entitled to a deduction of 27.5% of the greater of remuneration or taxable income. Right, so let's just stop the bus there quickly. We've got two aspects here then. We've got payroll and we've got income tax. So from a payroll perspective, the maximum deduction that an individual will be allowed is 27.5% of their remuneration. Now bearing in mind their remuneration is going to incorporate 80% of the travelling allowance, 80% of the use of motor vehicle or whatever comprises tax net remuneration at the end of the day for PAYE purposes. Right, that will be their deduction. What's the secondary aspect to that? If it's a company contribution that you are currently making, that company contribution will now be regarded as a fringe benefit. So in other words, the 20% will be added under income line and the individual will be entitled to a maximum of 27.5% deduction. Are you all following? So for 99% of the people, I should say 90%, not 99, but for 90% of the people, there'll be absolutely no tax change on their net pay going forward from the 1st of March. Because it's effectively in and out in the same scenario. What are the concerns? The concern is that we have a capped amount of 350,000. So nobody is entitled to a deduction for income tax purposes where the amount exceeds 350,000. Now, is this a problem? Most definitely. Because if I'm earning 2 million rand a year, I'm not interested in contributing more than 350,000 because I'm not going to get a tax deduction. I'd rather pay tax now on that money and take it and do what I want to do from an investment perspective. Why? We don't know what's going to happen in 20 years' time. We've just seen this major change to the pension providence. We can't foresee what's going to happen in 20 years' time where they might say, okay, no longer it's not 1/3 anymore that you're entitled to take out. You're not entitled to take anything out. You can only take a monthly pension. It can happen. We don't know what's going to happen. So we've got a problem here, because effective from the 1st of March, most of our pension provident funds that we have, the rules stipulate that your contributions are going to be based on cash salary and other amounts as decided from time to time. Those of you who have got funds will know that's pretty much the stock standard. Now, in situations like that, the individual earning 2 million rand will have to make his contribution based on the percentage of cash salary in that, which means it could exceed the 350,000. So what would happen is, let's say my contributions on 2 million, how much is that going to be? 550,000 effectively. So I'm losing a deduction of 200,000. So I'm paying a contribution of 200,000 rand, and I'm still paying 80,000 rand in tax on it up front. So if you want to factor that in from a planning perspective, what you need to start doing is amending your rules now with effect from the 1st of March 2015. And what you can do, one of the recommendations is say your contribution is based on cash salary and other amounts as decided from time to time, capped at a limit of 350,000. You're following what I'm getting at? So those high earners at the end of the day will still contribute the maximum that they entitled as a tax deduction, and also you can factor in if they opt to make additional contributions, they can, but from a governance perspective, 350 is your contribution. That's one aspect. But if you want to change those amendments, you need to do it now, because the FSB is taking about 6 months to approve changes to fund rules. Now the last thing is you want to wake up on the 1st of March and the directors say, well, we're not interested in contributing in these amounts because of the changes that are coming through. We want to limit that. It's going to be too late. Well, it's not going to be too late. You'll have a period where you effectively still have to contribute until those rules are factored in.
Why would that not be considered evasion? If we're going to change rules specifically to avoid...
No, it's your contribution. That's what I'm saying. So I'm saying I don't want to contribute more than 350,000. The question was, wouldn't that constitute evasion? We have not evaded anything here, because effectively what we're doing is we are limiting our tax deduction. So in other words, we don't have to contribute. There's no forceful aspect that you have to contribute to a pension provident fund or a retirement annuity. It is if you've got a pension or provident fund. You know, so they can't force us to make a contribution. So in other words, we are therefore entitled to limit and say we're only going to do it on 350. Okay. Please bear that in mind, because 90% of the people's retirement planning has been shot out the window. Because what they normally would do in that aspect is they would have a provident fund so they can pull out their full money when they reach retirement, so they can pay off their house and pay off the school debt and everything else that the people have, because trust me, even at 65 you're still paying for your kids at the end of the day. And they would then have a monthly contribution being received via retirement annuity or something like that. So all that's now been shot out the window. And the next we're going to look at is how we actually determine what those are and where their amounts are. But these are your contributions now from a payroll perspective. They're in the Act already, applicable 1st of March 2015. So it's not a thumbsuck or a change or this is maybe what's going to happen. This is confirmed. Okay. Is there any questions on that? Just there's no questions today. It's just like everyone knows the answers. Nobody asking questions on the webinar either. Okay, we don't know. All right. Let's move to the next one. There's a whole bunch of details that you can look at, but effectively there's examples in here too. But that's a simplified aspect. So from a payroll parameter perspective, you know what to factor in. Okay.
Should you change your rules now? Because obviously people are going to be getting salary increases.
Look, the question is, should we change the rules now? I firstly think you need to have, from a trustee's perspective, have a discussion. What is the membership contribution, and do the people actually want to contribute more than they're going to get a tax deduction for? All right. You can effectively go along and do that application for amendment rules applicable from the 1st of March 2015, and you do it now, once the trustees have decided to move forward on it. And also what you need to do then is, obviously, because we don't know whether the 350 is going to remain 350 or if they're going to increase that amount in future. And if that amount then changes, then obviously you will align it accordingly at the end of the day. It's purely and solely there for those individuals who do not want to contribute more than what they're going to get a tax deduction for. You know, they believe that if I'm paying tax on it, I might as well pay the tax on it now, take those funds and invest it in my own vehicle where I at least have control over it and not governed by the rules of the fund. Okay. Which makes sense to me. I don't know for you, but certainly I know individuals get when they comes to a tax deduction and when there's no longer a tax deduction. Who will benefit out of this? Obviously, the people that will benefit are those with a retirement annuity, because they've always been limited to 15% of their non-retirement funding income. And in a lot of instances, those individuals are contributing more, which creates a rollover effect. Now, by increasing that 15 to 27.5%, they'll effectively have a better benefit in terms of their contributions that they've lost out on. Okay, those are the only guys who are going to have immediate benefit. The rest of you will pretty much be exactly the same. It's in and it's out.